What's up, guys? Back with another video today, and let me just get into forwards, futures, and options. I know I talked about forwards and futures last video, but I feel like I need to go in a little bit more detail, make it more simplified. So let's get to it. So forwards and futures simplified. So forwards are done over the counter, which means that's done between you and somebody else, buyer and seller, whereas futures are traded on an exchange. So when it's over the counter, you, a buyer or a seller, or another buyer and seller, so basically two parties in a private customizable agreement, mind you, they are able to do business without the exchange overseeing it. So futures are traded on exchange. So over the counter, you and somebody else. Now they're less liquid, the forwards are. Futures are more liquid. So that means that they're easily able to be converted into cash. So with forward contracts, no, because you're waiting on something for the future. Whereas the futures contracts, you are more liquid than the forward ones. So, excuse me, payments. So do you have to pay a fee to buy a contract? Well, with the futures, you have to have a money in payment that's required. Whereas the forward contract, you don't have an initial payment, so you don't have to worry about putting money in at the beginning. And for settlements, so futures settle daily, whereas forwards settle at the end of the period when the items are deliverable. So with futures, you can do it on commodities, gold, stocks, and bonds, and also futures are quoted on the exchange, my add you. So forward contracts are the transaction between a buyer and a seller. And remember, it's private and customizable, so you guys can have any terms in the agreement as long as you two agree upon it to make it a contract. And there's no guarantee of settlement until the date of maturity. Whereas the futures obviously sell on a daily. The last trading day of that futures contract, which is the final settlement and delivery, is made according to the notes in the contract. So one thing both have in common is that their notes will tell you the date of maturity and what needs to happen on that day. Obviously, things have to be delivered, things have to be done. So on the futures contract, it's traded on exchange, whereas you won't have to worry about a buyer and a seller. Whereas the forward contract, the buyer and seller have to commingle and talk about what's going to happen in the contract. So might want to remember, for futures, you have to put money in regardless. For forwards, you don't have to put money in. So let's talk about options. So options, one thing I want to come on top of the head is that options, one contract equals 100 shares. So options, you have buy, which is call, sell, and put. So selling and put is the right to. Just want to add that so I don't have to get anything misconstrued, is that the right to buy or the right to sell from an options contract. So that means you have the right to buy something or the right to sell something, and at that strike price or exercise price until the expiration date. So you have to pay a premium when you hedge with options, and that premium will protect you. We'll get into that in a little bit. It's protected if there's an increase or gain on contract, and you can buy the same number of put contracts as you would sell of futures. So buying the right to sell, and we're just going to get a buying right to sell, just to sell a put option, comes with that fee, which is that premium. So with your put option, now put, one thing in the world of finance that put means and that we all should know is that if you buy a put option or you buy anything with a put, that means that you want the right to sell because you feel like something is going down. So let's say, for example, you want to put a put against a stock that you feel like is going in a negative. They are either going bankrupt or they have bad PR. So like, yeah, I'm gonna bet against it. So obviously there goes the whole borrowing shares thing, etc., etc. But we're not gonna get into that. We're gonna keep it strictly on the option. So whenever you put a put or you write a put, well, not write a put, excuse me, writing is kind of words of selling, but let's just say that you're buying a put. So you have the right to sell, and then when your portfolio decreases, which means it goes down, now remember, put option, you're betting against it. So that means you want to go down or stay the same in some cases. But the put option, when your portfolio decreases, your options position is up and your portfolio is the net amount of the position is up as well. So what I'm saying is that once you have that put option and your portfolio goes down, so that means the stocks or whatever you bought decreased, your portfolio is up that net amount because you have a put option. You say, I'm betting against this, so I'm betting it's going down. So whatever net amount that is, then that was your portfolio is, it's up in a way. Your portfolio position is up, not the portfolio, but the portfolio position. So that means the position of the underlying commodities or stocks, etc., that you put a put option on, the portfolio is down itself, but that position of having that option is up. So that means you made money. Hope that's simple for you guys. And if a put option is bought and the portfolio goes up, that means everything goes up. The stocks go up, etc. Whatever you tried to bet against goes up, which is unfavorable. The options position will expire worthless, and the portfolio is worth what it's worth. So that means that your downside risk is protected with that premium, and there are some rare cases that the options you can go on a negative. I heard that's when you have the contract returned to you and you owe somebody for the shares, but I also have to look into more validity for that. But really, you really can't go negative all the time with the option. It's just for the fact that that premium protects you, but just know that it's risky regardless. Because you buy that put option and you say it's going to go down, it's going to go down, we're in a bad time, and everything goes up. Option's going to expire worthless, and the portfolio is worth what it's worth. So obviously, you lost some money technically, but you didn't lose money out of your pocket in a way. So whatever you put into the market or your options, you may have not recuperated or re-had it back. You did not have it back or re-add it to your portfolio. But the thing is, it's risky, and that if it goes up on a put, then you basically lost. When everything goes down, you're gaining, you're winning. So to make it simple, a put option, everything goes down, the stocks, whatever, option position is up. So if your portfolio goes down, so everything in your portfolio that is composed of with the stocks, etc., those numbers go down, your money goes up that you put in. Whereas if you have the put and then the stocks go up, your money goes down. So obviously, like I said, the downside risk is protected with the premium, but still, the overall consensus for the technicalities of this, you will lose if your portfolio goes up, and if your portfolio decreases in terms of the numbers from the stocks, you will go up in your position and you will make money. So that is the difference between forwards, futures, and options. I hope it was simple, guys. I hope I explained it pretty good for you guys to understand, because buying, selling, put, call, all that stuff, terminology in finance that people have to understand whenever they're working with leverage. Because when you work with leverage, you will have a lot of risk, because people say, oh, let me go ahead and put things on margin. Let me go ahead and do options trading. But they don't understand the basic fundamentals that you are putting money in, basically like a gamble. You're saying this is going to go up or this is going to go down. This is going to stay the same, etc., etc. And if you don't understand what to do at what time and where to do it, you're going to incur a loss. That downside risk may or may not be protected. Depends on what you have. See, with that premium or fee, you're protected, but with other things, you may not be protected, because you have cover calls, short calls, long calls. You have a lot of things. So maybe in the next video, I can explain more of that. But for right now, I'm just going to keep on track with it. So thank you guys for watching. Tune in for the next video, and we may discuss covered calls, long positions, etc. in more detail. Thank you.